You're listening to Brick by Brick, a work boots approach to your wealth, creating financial empowerment through independent, personalized, and authentic financial planning.
Connor Theofolt is a certified financial planning professional and wealth advisor at LGH Wealth and co-host of the Brick by Brick podcast. And we've got him. Connor, how you doing?
Al, I'm doing well. Thanks for having me.
I love the podcast. I think you started last week, right?
Yep, officially launched Wednesday.
All right, so I saw that. You do, they're many, I don't know what you social media gurus are all about. And then you do these little 1 minute jobbies about what was in the podcast.
Shorts, yeah. Yep.
Okay, that's a good name for that, by the way. Shorts, okay.
Yeah, the short videos, yeah.
Yeah, I get the kind of, okay, thank you. But you're putting those out, because I've seen those in a couple places, like on LinkedIn or something. Okay, because this is what I like about you, LGH, the way you're doing this brick by brick thing. So you come on here, we talk. It isn't necessarily financial advice. It brings up here. There's some guy that shows up on like my reels. Is that what you people? Your reels?
Same thing. Yeah, okay. That's just Instagram's version. Shows up.
He's just walking. I'm a retired financial guy. If you thought about, and then he throws something out like you should be buying this or that. I'm like,
is that the guy walking in the woods?
Yeah, the woods guy.
Yeah.
Mm-hmm. And I'm like, well, wait a minute. What if that? And you got a question, and how can he throw stuff out that's good for everybody on a video and just say, yep, buy this or don't do that? How can he do that?
If I'm not mistaken, the last part of the video says this is not financial advice.
Well, yeah.
That always gives me a bit of a kicker. But
yeah,
there's a lot of that out there, and not everything he says is bad. I've seen a couple of his videos, and okay, sure. But the reality is, like we've talked about before, Al, rules of thumb don't go very far with me, because people, I keep saying it's amazing how few people are the average, how few people are the people that the cookie cutter is what's perfect for. And a lot of times people need more than just, here's your cookie cutter solution.
Well, it's never not happened with you on this program, is that if we bring something up and we get talking about it, it makes about 4 other questions that I got to ask because of this. And it's so individualized that blanket stuff, other than piquing my interest to hear the words that I don't understand, like shorts. Thank you. You need a guy. You need a guy like you guys that'll say, okay, I get it. You want to talk about whatever guy in the woods said, but this is how it works in your world. Everybody's got to have that. You were doing this thing called February fallacies in finance. Did I get
February financial fallacy? February, yeah. That's a lot of
all the right words. Yeah. This last one? What was the last one about? Because it like recent bias.
Recency bias was one from this week, which basically the premise of the segment I'm doing is helping people point out and realize, oh, I'm actually kind of using that financial issue, or mental issue, I should say, where we fall into these traps just through our nature, and recency bias is one of them. And it's the tendency for us to assume that what's happened recently is going to continue. And we sort of throw out the historical, what's happened over the long time. And we tend to all of a sudden forget that this thing we're focusing on right now that's happening right, in the last handful of, again, recently, we think that that's just going to continue forever, and we sort of tend to discount the long term, what's more of a trend potentially.
Well, see, but you can see how that works. So I am old, and I want to say I remember when they were saying the Dow couldn't get past 20,000.
Mm-hmm.
Right? I mean, it's like, what? The world's not worth 20,000 points. And we were never going to get past 20,000. And in my lifetime, didn't we hit 50K like this week sometime or last week? Didn't we hit 50K?
Yep.
Well, then that just shows you got to be in, because what? You can go to 100. Is there an end?
Well, theoretically, there's not really an end. But the thing that has been happening recently is we are seeing a break from the trend that's been happening for, I would say, an intermediate amount of time, which is large U.S. tech stocks for the last, call it decade, but certainly 4, 5, 6 years have been the most dominant asset class, essentially most dominant asset class out there. Your NVIDIAs, your Apples, your Microsofts, your Teslas, your Amazons, they have just dominated everything. And what we're seeing right now is something like the Dow, small companies, international companies are all doing better than the S&P or your U.S. large tech stocks. So it's interesting because it's almost like people continue to pile into tech stocks because recently that's what's been working. And then when it stops working, now people are going to want to pile into something like the Dow, which is your companies like Home Depot, Walmart, Johnson and Johnson. That's the danger with the recency bias is if you're just chasing the thing that happened to be working the last time you looked at it, you're going to find yourself probably behind a lot, which is why diversification, tends to win out over long periods of time.
Well, and then that back to having a plan so you don't have to worry about all this stuff and have somebody figure that out. Because I think I was reading on you do like a monthly how things are going report on what do you call it? Your whatever it is.
Market update, market economy update, yep.
In there, because I read it, figure I go do some reading. You said that the stocks were swinging sharply because the tech was selling off, but yet it went over 50K. How does that work? If the big guys
that's the thing that I think sometimes people miss. So the S&P 500, or what a lot of people refer to as the market, is quite a bit different than what people refer to as the market when they say the Dow. Again, if you look up the top 20 holdings of the Dow Jones, it's a lot of, again, it's Walmart, it's United Healthcare, it's Johnson & Johnson, it's Home Depot, it's Cisco. It's more value tilted, meaning it's more established companies with cash flow. They're providing a lot more, I would say, homey things, whereas the S&P is your high tech flyers. It's it's just a completely, not completely different, but it's a very different index. The closest they get to overlapping is Nvidia, and I believe Apple is in the Dow still. And so the Dow is up, pushing, I think, 6% this year, and the S&P is up 1 or just a little positive. And the NASDAQ, which is another stock index that is commonly tracked, is actually negative for the year.
See, that is, okay, this is why, again, a commercial for you. That's why you got to have a guy. Because I think I know what I'm doing, and I obviously know I don't know everything. But when I want to find out how the day went, I type in, how did Dow do today? And it gives me a number. I don't even think about NASDAQ. I don't think about the S&P. It's just how the Dow do, and I kind of live by that bias.
Your guy in the woods, if somebody was paying attention, if they had done exactly what he said, which is commonly by the S&P, then they would be pretty disappointed when they look at the news and then they look at what they bought because of what he told them to do. And that's just the reality. Cycles happen. Business cycles happen. Certain businesses do better in different environments. Certain investments do better in different environments. And that's why diversification is important.
Well, let's talk LGH for a second then. When you guys get together, your gang of brilliant minds there, how much do you look? Well, I know this sounds bad. I'm sorry. How much do you guys look at? Like, they got a new Fed chair. Does that spook you or make you happy? And again, back to I don't even want to have to worry about stuff. I just want you figure that out and let me know if a new Fed chair bothers my portfolio. No. What would I do with that? That's the
I mean the really risky thing that people would do is, hey, the Fed chair is more likely to cut rates, or the Fed chair is more likely to not cut rates, and so we're going to make a huge change to the portfolio. That's a huge bet, so to speak, on this decision. We wouldn't do something like that. That's over the top. But if we're coming into a cutting environment like we've been in the last year, a little more than that, and certainly we think we're probably going to get some more cuts here this year. It sounds like we might position ourselves a little more, for example, tech focus, because they tend to do better when rates are lower. Maybe a more small cap focus because they tend to do better when rates are lower. Financials could have an argument. They could also have a tough time. It just kind of depends on how it shakes out. The Fed chair maybe isn't as big a one. We got the jobs data this morning, which the market hasn't opened yet, but jobs absolutely smashed expectations. The funny thing for the last handful of years in the market is that when you get a good reports and good data, a lot of times it turns into a down day. And when you get bad data, it turns into an up day. And a lot of that has become dependence on the Fed. Basically, if things are going well, the Fed's not going to cut rates, so the market goes down, and this whole game. See, I don't want to. That's why you don't want to focus on the short term primarily.
I just want to be the radio guy. This is not stuff. I think people driving in their car listening to you going, holy crap. Let Connor get up and drink coffee and find out if the job rates are going to do anything for me. I can't live like. How do you get up? The coffee, I presume, is the only way you get up in the morning. I mean, good,
it's the only way.
I can't imagine. Oh, job rates. Can't wait to get up in the morning. I don't know how you sleep. I got to go to break. I will throw this at you because I know now that it was completely fake. But it's the stuff online. I want to throw this at you. Somewhere on Sunday afternoon, because I was scrolling around, we had Super Bowl, stuff like that. I'm scrolling around, and on X, I'm sure it was X, some great X name. It was a financial. I don't know who it was, but it sounded like we know a lot about money guy. Was warning everybody that the Chinese were going to sell off $1 trillion worth of stock of money. The markets sell now. And I'm like, I don't know what do you do with that information? Is it true? Well, Monday came and went, and evidently, how did those, on the other side, why do people do that? This guy, obviously the Chinese didn't sell off $1 trillion in assets. What did they get out of that? How do they make money? Why are they doing that to guys? I'm like, oh my gosh, if this is true, and it sounds like a good name, like We Know Money X or something, we'll talk with Connor after that. I don't know why these people do this stuff to me. It gets my blood pressure up. More after this.
At LGH Wealth Management, our mission is to create financial empowerment through independent, personalized, and authentic financial planning. That means meeting you where you are and helping you get where you want to go. Whether you're a business owner planning for growth, succession, or a future sale, or a hardworking individual looking to get ahead, reduce stress, and tackle life's financial challenges, we're here to help. From retirement planning and investment management to tax-efficient strategies, estate planning, and risk management, LGH Wealth delivers comprehensive guidance you can trust. Call LGH Wealth Management today at 507-525-7324. That's 507-525-7324. Securities offered through J.W. Cole Financial Incorporated, JWC, member FINRA SIPC. Advisory services offered through J.W. Cole Advisors Incorporated, JWCA. Lubeck Geisler Ham Wealth Management Incorporated and JWC JWCA are unaffiliated entities.
It is the Al Travis Show. We're doing Brick by Brick with Connor. Connor, when I went into break, my point being, since I start having you on and I liked you and I started looking around for things for us to chat about, now I'm seeing this weird stuff. This guy on X with, We Know Money or whatever, he literally said he talked to a deep insider in the Trump administration. Yeah. So you knew it was going to happen and they're going to sell off $1 trillion and the world, and I'm like, well, first off, what would I do with that information? Do you buy when it's low? And I'm like, how do they make money? Why are they screwing with people like that? I get the guy who tries
that sounds like impressions to me. That sounds like they say something very alarmist on social media and they get a lot of likes and retweets and comments and they make money because of the impressions on their social media. That's what that one sounds like. I don't know for sure, but that'd be my guess.
Because
or they were wrong.
Yeah, or some Chinese guy forgot.
They were just wrong.
Some Chinese guy didn't push sell. That's why I didn't go. But I guess it's back to if you're trying to do this stuff yourself. You're my age. You're last thing you need is to be suckered into something stupid. You need a guy let's go with LGH, right? You need a guy who says, hey, Al, I'm pretty sure they're not selling off $1 trillion in China. We're going to be okay. You know what I'm saying? I need a guy like you, because if I didn't have a guy, I think I would have been crazy yesterday. I was sitting there going, oh my gosh, and it's a long red. People fall for that stuff, I presume. That's why they do it.
Well, in the end, we talk about it in the podcast episode coming up. There's a really interesting study done decades ago and continued to be updated by Vanguard called Vanguard Advisor Alpha. Excuse me. And basically, the premise of that study was they set out to prove, well, I don't know for sure, but I imagine Vanguard, the father of the index fund, the do-it-yourselfer company, set out to prove that you don't need an advisor. And what they found was an investor who has an advisor or a confidant or someone that can check them in moments like that where they're scared, or they see something, they want to make a knee-jerk reaction. They do about 3% better per year in real returns over the course of investment. Now, there's a large swath, right? There's a large dispersion between people, but right around 3%, and about half of that 3% better is simply market timing. It's the don't try and play the up game, the in game, the out game, all that kind of stuff based off of headlines and news and Fed chairs and whatever. It's sticking to the long-term plan. And if you build your portfolio in a way that's not designed for, we're going to change it tomorrow. If you build it for, this is just our long-term or our intermediate term plan, it tends to be a little more elastic than those headlines.
Well, and then to get back to having a guy. So I presume getting all those letters behind your name, getting to be a financial planner and all.
Yeah.
You must have taken some psychology classes. You had to for guys that would call you up, and you had to, right?
Yeah, Kyle on my team and I, my co-host with the podcast, we talked about, he studied psychology in undergrad and just got really interested in how people work. And I, as part of my master's degree, actually got a designation. Behavioral finance is kind of the psychology in our world, and it's about 70% of what we do. I mean, most of the time when clients call, it's, I would say that's not probably true. Most of the time when they call, it's, hey, can you send me some money? But, or hey, let's, whatever. But I would say a big chunk of the time, it's okay, saw this thing. What do you think? Or, and the reality is, Alec, we talked about last time, most of our clients have figured out that we're on it. And when we stay in constant communication and when things are happening, we're going to proactively reach out versus them having to give us a ring. But the psychology of people and the financial fallacies is something we all fall into. So being aware of those things and then being able to react when you realize you're in one of those kind of mental things is a pretty big skill.
Yeah, you start reading that stuff, all of a sudden more of them show up in your rhythm or your algorithm, and all of a sudden you're just going down this swampland. So if somebody were listening and they're driving down the road saying, you know what, I could use somebody, at least if I can get 3% more on average or whatever, just because somebody's going to keep me from doing stupid stuff, how do they go about doing that?
Yeah, you feel free to reach out. Connor at lghwealth.com is an email. Easy enough. You can check us out online, lghwealth.com, or check out the podcast, the Brick by Brick podcast on YouTube. Get a little more insight and maybe get a bigger feel for how we operate. Yeah,
and you get a feel for who you guys are. That's kind of my point, is that you're not the guy wandering down the woods just throwing out hey, this will fit everybody, buy, or sell. You explain the situation that's going on, and you take the time to do it. I enjoy the podcast very, very much, and it's Brick by Brick. That's all you look for on.
Yep, the Brick by Brick podcast is how you find it on YouTube. Yep.
All right, and if somebody want to make a quick phone call, is there a number they could do? Do you know?
507-525-7324. 507-525-7324.
Connor, I appreciate you being on the program. I really do. I think you take a little of the mystery out of all this. You come across as a guy could trust to cut me down when I find out the Chinese are selling $1 billion. I
didn't get that call, Al. That would have been interesting. I would have had to do a little reading on that one.
Well, it was like, what? And he said, I have an inside with the Trump. And I'm like, well, he's got an insider, then I must. But it didn't tell me what I saw. I got taken. I appreciate you, Connor. I really do. Appreciate you coming on. It's
thanks,
Brick
Al.
by Brick on the Al Travis Show.
You've been listening to Brick by Brick, a work boots approach to your wealth, creating financial empowerment through independent, personalized, and authentic financial planning. The preceding program is sponsored by LGH Wealth Management, which is solely responsible for its content. Securities offered through JW Cole Financial, member FINRA SIPC. Investment advice offered through JW Cole Advisors. LGH Wealth Management, JW Cole Financial, and JW Cole Advisors are unaffiliated entities. The opinions expressed by the advisors at LGH Wealth Management should not be construed as specific investment, legal, or tax advice. Annuity guarantees are based on the claims paying ability of the issuing insurance company and state agency limits. All economic and performance information is historical and not indicative of future results. Investing may involve the risk of loss of principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax penalties that may be imposed on such person. Each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. The financial professionals at LGH Wealth Management are not providing legal or tax advice. Nothing should be construed as solicitation of an offer to buy securities.